Bonjour to everybody here today. Just so you are aware, this is being recorded. So we appreciate each and every one of you being here today. Our email went out about our 2-week mastermind. I believe it'll be the same link every week. Is that correct, Sonny? So yeah, she happens to be muted right now, but I'm getting the head nod. Perfect. So just so you're aware, save that. We got another person here joining here. So we'll have a couple people trickling in. What are we talking about here today on the Mobile Mailbox Money Mastermind? We've got a couple people we've talked to over the past few weeks. We just got back from the Wealth Protection Summit in Ponte Vedra, and that's what we're talking about today. Talking about how wealth protection serves such a high value to high net worth investors and people wanting a passive return, but not wanting the volatility and, the potential risk of loss at the end of the day. And, where does that fit within investors' portfolios? I see Jamie here. We met at Arizona Real Estate Investors Association. We'll touch lightly on a couple other of the events that we're attending. But hey, Jamie, appreciate having you here today.
Yes, it's good to be here.
So today, again, is about wealth protection. Investors are really wanting a safe play right now out in the market, not only for an income-oriented investment strategy, but also retirement savings, which ties into how Jamie came into contact with us. Was she had money in an IRA. She has money in an IRA, and she's wanting to invest for retirement, tax-deferred or tax-free, through an IRA. And most people don't know that you can do that. And with the wealth protection caveat received in note investing, there's where it kind of comes all full circle. Why is notes such a safe place for investors to place capital? What makes a performing note, such a great vehicle to hedge a bet, say in a long-term retirement savings account? Here's a couple factors, long story short, of what individuals who raise money to talking to investors that they portray the benefits. I will also here today to understand, right, is the fact that these notes are collateralized, right? So you have a collateral-based investment strategy with a lien position on the property. So collateral, you're positioned on title. You don't own the house, because our objective is not to own the house. What comes with complications of owning real estate? Your property taxes, maintenance, insurance,
tenants, termites, and toilets.
That's if you have it rented out. Maybe you were trying to bank on appreciation, at the end of the day, and you just left it vacant. Some high net worth investors do that. But that comes with its bags of tricks, right? So, we don't want to own the asset. We have a security on title, but we don't own the house, right? We have a documentation and ability to repay on the borrower. So not only do we not own the house, we have someone in the house owns it, paying us, who qualified to buy that home. So we have a lien position, collateral, a performing borrower, right? Who that borrower didn't just come to the table. They came to the table with documentation in order to fulfill that satisfaction of an ability to repay to get the loan. So we went through all these steps for the gold nugget of creating a mitigated risk. There's risk in investment, but what are the steps that we took in order to provide the thing secure and protection, for the capital at the end of the day? So those items, in order to portray to other individuals, even sitting here today, gives you kind of some further thought process of like, hey, I've got all these different options out in the market, right? You have annuities, you have bonds, you can put your money in the bank and make 3%, maybe 2%. And is it really safe in the bank at the end of the day at any given time? This is a double-digit rate. So not only getting your wealth protection, within what you are looking for out in the market, but now competitively depending on what you're looking at out in the market or what your financial advisor is chefing up to you, it just goes to show where this fits possibly within someone's portfolio, long story short. So wealth protection, wealth preservation, what are the options out on the available market, and how does that compete, within what we look at on a daily basis, maybe being pitched by our financial advisors. So we mitigate that risk, and outside the stock market, and a collateralized private lending component in a performing asset opposed to non-performing and reperforming and commercial notes. This is a single asset from $50,000 to $150,000. It's not a large multifamily play where they need an institution to buy it for $5 million. These are hedged across multiple doors, providing further diversification and protection for that portion of your portfolio. So say it was like $500,000, right? You invested $500,000 either in the fund or in the notes. So $500,000 could get you like 5 notes, call it. And on 5 notes, I think here, let's just see real quick what an average note is. So average note's like $100,000. Just kind of benchmark. That's the unpaid balance. We're talking average yield of 14% on a 20-year amortization schedule is 1243 and change. So 1243. My phone's blowing up right now. Sorry, give me 1 second. 1243 times 5 is $6,200 a month with $500,000, right? That you, with no maintenance, insurance, taxes, and things of that nature. So where else can you operate like that in the industry? And cash flow, if you're in an IRA, it's going to go to your IRA, right? So that goes tax to free, which is additional return on investment. But if it's coming to your account, where else can you get that passive payment, at the end of the day, in a wealth protected program, say for $500,000, that was a portion of your portfolio or what you had in your IRA at $6,200 a month, and you stacked across 5 doors for $500,000 to try and replicate that in residential property. Where are you going to find success for $500,000? Maybe a $250,000 condo in a less desirable market. What is that cash flow at? Maybe that was two condos in a less desirable market. You're trying to do a long-term rental strategy. It just doesn't end up penciling out right now, unfortunately. So with that being said, that's where this should fit within someone's portfolio. And I think talking more about the wealth protection and preservation is more important than seeking high yield, high return on investment, because ultimately that will procure different questions and individuals ultimately seeing the value in the collateral, the lien position, and the performing nature of this asset. What are your thoughts, James?
You tell the right story. I'd like to back it up just a little bit and simplify it for most investors. Look at single family homes in the Midwest market, that used to be a really cheap market. You could buy in Indianapolis or Chicago, you could buy a note or a single family home for $40,000-$50,000 years ago. And that's no longer available because BlackRock came in and buying up essentially in the entire country and raising rents. So, as an investor, a regular investor is first looking at the collateral situation and the viability of the actual note. The viability really of the note starts off with what? The ability of the borrower to pay and how they've been qualified. And I think if you step back just for a second and think about, normally when somebody gets qualified for a regular loan for a single family home or whatever, they're just doing their basic qualifications of debt to income and their credit score. It's a completely different model, and it's a much higher criteria requirement to get approved on manufactured homes in parks, which a lot of people don't realize that. And I think sometimes we have to take a step back and actually just kind of break it down a little bit more of having some actual conversation. Because at the end of the day, a note investor just wants to make sure, is this note going to perform? So I would raise my hand. I'm an investor. If I'm agreeing to buy a note, I just want to make sure that what's the best chance that this note is going to perform in comparison to a note that would go non-performing, because obviously there's additional expenses that come in of eviction and so forth that come into play. So the kind of cool part about low-cost housing and manufactured homes and parks is that the people actually have to get qualified twice. And I think that's really important for us to kind of just backtrack and kind of go through that, because a lot of people have to hear it multiple times and realize, oh, I'll tell this to specific investors multiple times, and it takes them like sometimes everybody's different, 3 or 4 or 5 times. They're like, oh, this buyer on a note on a manufactured home in a park, they had to first get qualified with the mobile home park before they even get qualified with us. And the park is going to require and verify a couple of critical things. They're going to see if this person has ever had an eviction. If they've ever had an eviction, they can't get approved to own in the park ever. Okay. If they're a felon, chances are they're not going to get approved. They need 2 years of provable income, and they need on average of about a 600 plus credit score. So I got to put my fingers up on the screen correctly. Those 4 things, and there's a couple others that they put into play, but those 4 things actually really are knockout deals for probably a good percentage of people that we pre-qualify and submit. Sometimes they don't get approved because they tell us one thing, and when the park runs the actual verification information, something comes up and they don't approve them, or they can't prove their income. So the cool part about this specific program, it raises the bar of the validity of the note, because the reality is, if you're trading in this space and have looked at it before, if you haven't looked at it, you think, really, they'll let anybody in a mobile home park. Anybody can buy in a park. They just, put a down payment, and they don't do any background checks. It's, there's no qualification. It's a mobile home park. Nobody wants to live in a mobile home park. Where the reality is, because the market has gone so strong, and especially like a top 3 market like Arizona, Maricopa County, it's a major move to market across the country. It's in the top 3. And because of that, with causing rental prices to remain high, causing housing shortage, the alternative for a blue collar worker that's making $30,000 to $50,000 a year is either they can rent, and that's what this economy is getting us to. You can either rent forever, or you could look at possibly owning a mobile home in a park, which is the low cost housing component. The reality is there's not even that many homes in Arizona. I think there's 300,000 the last time that we kind of did some research on it in the state of Arizona of manufactured homes. But a big percentage of those are 55 and older parks, and then there's all age parks. We invest in both. We invest in the 55 as well as the all age, and different parks have different benefits because of the quality of whatever the park is. But going back to qualifying these people, remember this, we can't lose sight of this. They have to first get qualified with the park and all the criteria that the park is requiring. And then second, they have to get qualified through us. Oh, I saw a couple balloons. Anyway, from that,
It's good timing.
yeah. So from that,
Sorry.
on that second component, we run them through the National Dodd-Frank evaluation platform. So we want to make sure and do our best to get them approved. And Dodd-Frank is a standard national program. Our goal is to have somebody that's not Dodd-Frank compliant as well as park approved, and they're actually a higher tier possible buyer. They may have actually be able to qualify to buy a home because of their income and so forth, but they're choosing to live in the park because of, for whatever reason, maybe it's because they're going to get a lot bigger allotment of living, meaning 1,000, 1,200, 1,500 square foot remodeled home for $150,000 or less. And, or they just like the environment. They understand the environment of living in a mobile home park, or just the financing component just comes into play. So as we go back and look at that, just remember the main goal of it all, and I know we got a hand raise and we'll get with you, but the main goal of it all is that if you're investing in a note, you want to buy a note that you feel with highest confidence that it's going to perform. Go ahead, Jamie.
Well, first, I totally agree with you, James, on the qualification. I've had clients that were trying to buy mobile home parks for cash and couldn't get accepted into the park. I mean, they had 150 cash and couldn't get in,
Right.
because of the park. But my question was, what is the Dodd-Frank compliance platform? I have not heard of that.
So Dodd-Frank compliance is a national platform, and it runs primarily a DTI, or debt to income component. So it not only runs a debt to income, they do a credit score. So they're going to do a credit check, and really it's the ability to repay. So abbreviation is ability, A2T, repay, or ATR, ability to repay. So it's just the
Dodd-Frank was passed in 2009.
Right. I'm familiar with it. I'm familiar with the Dodd-Frank Act. I just didn't know that they had a component where you could qualify people rather than going through a lender. So
the act actually states the stipulations of what makes it compliant and not, and we use a third-party underwriter. So that underwriter takes their application and puts it subject to what Dodd-Frank's limitations are, and then it meets or doesn't beat that through the third-party underwriter who takes the Dodd-Frank in consideration.
okay, so you're using the Dodd-Frank rather than using a lender.
NMLS, the National Mortgage Lending Service, uses Dodd-Frank as their standard for compliance. And that includes not only the debt to income ratio and the ability to repay, it also includes no felony convictions, no evictions, no active bankruptcies, those other types of stipulations.
Okay, thank you.
So as we kind of walk through that, a lot of times we do have to step back because we'll run past the very beginning piece. The beginning piece is as we present these deals, out to specific investors, we are presenting them on the fact that we just don't have enough capital. We put together Silvercrest Opportunity Fund to bring in more capital to take down the deals. If it was our at our discretion, or as we raise more capital in the Silvercrest, we're probably going to take and keep the majority of notes that actually come in. Right now, we don't have enough capital, so we're bringing the notes out to the consumer market, and we're willing to work a couple different programs. The investor has a choice. All of our notes essentially, actually, I would say 99% of our notes are ranging 14% principal and interest. That's our standard basis. I would say 99.
James, we have a question on the board. It says, how many investors have invested in notes with your company, and how many of those borrowers have defaulted? What happens when a default occurs? And I think that the answer to that is that with our NMLS certification, we are able to generate institutional quality notes in-house, and we average somewhere around 25 to 30 a year. Is that what you think?
So we've done about 175 notes over a 7-year delta. And we have probably a 2% default rate. It's decreased over the years with our increase in qualifications. It's a great question because ultimately that's the risk within the strategy if it goes non-performing. Well, what happens if a note goes non-performing and say a note investor bought that note in its entirety and they hold it in their portfolio? Anyone that buys a note from us in total, and it came from us. We originated it at cost. We'll provide them our back office brokerage, largest dealer of manufactured housing, sales staff, management, and attorney retainer for eviction. So it's probably like a $3,000 repossession total within a 40-day delta from non-payment. We're not so much in the business of taking people's houses back at the end of the day, but there is recourse, and that's about the time frame, about 40 days, if we were to go and take them to the delta immediately. Sometimes we have them go deferred for 1 month on the first month's payment, not first month, but first missed payment. And that's just up to the investor. That's something we've done in the past, because, things happen at any given time. Really, our objective is to keep the asset performing. So to go out and hire an attorney, someone could do that themselves. They probably spend $5,000 on a retainer, plus the additional expense due to the communities. They'll charge 1 or 2 months back rent. An average rent in the valley is $800 to $1,000 a month. We've had maybe one investor who's bought a note from us that it went non-performing or has in some variation of workout, and we're currently working with that individual in order to facilitate loss mitigation or maybe a potential profit. How many times have we taken a house back where we repossessed and actually made additional profit? It's been a few. Actually, more times we've taken a house back that we've made money than we've lost, and it's probably been a bag of 5 over the past 7 years.
So let's back up just for a second, because I always like looking at it on the investor perspective. And the two different perspectives is, if an investor puts up 500,000 as an example, they could invest easily into probably 5 different notes from us. So they're diversifying their investment risk. So they're taking a chance on 5 different deals that are paying a higher rate. In comparison to the 500,000 they could have in one note in Maricopa County on a single family home that's paying a lower rate. Let's say it's paying 8%, so it's about 6% less, but it's over about the same term. Say it's 10, 20, 30 years, whatever it is. But as we look at it, just know Arizona as an example, is a trustee deed state. Across the country, we have 2 different types. You have mortgage states and you have trustee deed states. And a trustee deed state in Arizona means that somebody can actually go behind on their mortgage if they invested in a note in a house or condo or, a regular note investment. The actual borrower can go up to 90 days late before they're even eviction. So that's 3 months that they can go late. Okay. So once they're past 90 days late, that means the note investor hasn't been paid for 90 days, 3 months. Now they're in full default, and now they're in their cure period of eviction. So now the borrower has an additional 3 months, which is a total of 6 months that note investor could go without earning any income and not knowing. Obviously, if somebody's in default and they're going through full eviction, they could have anything happen to the house because they don't own the house. They don't have any right to go to the house and protect anything. So the borrower could do anything to jeopardize the house situation because they know that they're about to lose the house. So we'll see the ACs get stolen, all the appliances are going to be gone, and the house just gets ransacked, essentially. It could happen. But the biggest premise to remember, the two things, with a note investment in a trustee deed state like Arizona, California, Nevada, those are all primary trustee deed states. The loan doesn't have to be paid. It could go up to 6 months before the borrower has the right to take the property back. And they have to be efficient and quick and actually order a trustee sale and put their notices and so forth. But the primary owner can live in that house for 6 months or longer before the owner of the note can actually take the property back. In personal property, which is manufactured homes and parks, it's very efficient. And based off of that efficiency, they normally have, and remember, there's 2 different things. they have a note with us, and then they have an agreement for their lot sale payment with the park. So if they go behind with the park or they go behind with us, within probably the first 10 days of them being behind, they're getting a pay or quit notice or demand notice. And that demand notice goes into full force that by the time you get to 30 days through our program, we have the right to do a full eviction essentially and take the property back. And our normal time frame goes from a single family home being 6 months or more to a manufactured home in a park. We may be able to take control back of that property in 45 days. So in other words, the note investor, their risk is anywhere from a month to a month and a half of not being able to take control of that property. We do everything we can, just like any lending company, that if somebody has a problem, we will see how we can mitigate the problem, because the main goal is to get the note performing. Maybe the person lost their job or something happened in their family that they weren't able to make that payment. So it's really important for a investor to communicate with the specific borrower to see what can we do to help continue that performance. Maybe it has a little blip, they lost a job or something, they need a little break here or there. But if they're completely non-communicative, or it's just not working out, we estimate that it's about 45, a little more than 45 days that we can turn that specific property, including hiring the attorney, going to court, and evicting them from the house, is going to definitely be under 60 days and take control of that property. So we utilize our services as a company. We make those available to the note investors that buy the notes from us. We do a cost-based program. And that's really important to know, because if you're buying in a Midwest market or any other market, you're alone. And if you have to get somebody and evict them out, it's all on you to find the attorney and find the company to help clean it out and so forth. So, I just want to put that out to you. It's a very efficient program.
I think a really big component to this process that James didn't say is that based on the amount of volume that we do in these communities, we've developed relationships within the communities where we'll hear about it right away. And through our relationships with the community, we'll get on board with finding out, on the ground level, what's going on, why are they behind, how can we help them? Can we help them get some part-time work? Can we figure out how to get them to catch up somehow? We're really trying to reach out to people in good faith to try to get through whatever life is throwing at them to make it work before it goes into legal. And we've been really successful at doing that within these communities.
So we're going to put the brakes on this real quick on just to understand we're at a crossroads here. So understanding that was a note sale. That's one of 50 investors we've sold a full note. We've sold to maybe 50, probably a regular batch of 10 who buy that note total for the full yield that's received from the paper. Average is like 14%, right, of the yield. That's buying a whole note in your portfolio. Did you know that there's a additional opportunity within hypothecation, which potentially mitigates an investor on this same note, right? I end up hypothecating that note to the investor, which means pledging that asset in order to garnish capital investment. Now stay with me here. That allows me to give you your collateral on the same loan with the terms of Jenny May, who qualified through seller finance. She has a $100,000 note. Yield is 14%. I can pledge that note at 10%, right? A lower rate, and give you your collateral. And I make 4 as your vested partner within that specific asset. So at no cost to the investor, within that program, we reperform that asset, the largest dealer of manufactured housing, and you still receive a collateralized double-digit interest rate with further mitigation within the program. And obviously, when reperforming that asset, I saw a question about like the lot lease fees and things of that nature, in question. Those would be ultimately, once repossession occurs, that would start ticking. So it's up to the investor who maybe bought that note in total to remarket the home for sale or use our sales staff, and ultimately they would be bearing the cost of that lot rent. Where with hypothecation, ultimately we would continue either on a deferred basis once we repossess the asset and ultimately mitigate loss or receive additional profit upon the resale as your vested partner through hypothecation. Now, in the fund, Silvercrest Opportunity Fund, that's the portfolio of notes that is hedged across the doors, opposed to being subject to performance of one single asset. The caveat is you do have to be accredited. That's about $1 million in net worth, or $20,000 a month singular, or 30,000 combined household income, and it's all excluding your personal residence. So these homes are in 55 and older and all age communities. I saw that quick question. Just kind of trying to get a couple of these out the way for you here, Ray. So yeah, that's kind of the differences between a single note acquisition, right? So maybe someone's not a savvy note investor. They've never been to a note conference. They never heard of the, availability to reperform a note. They may not know how to do a workout with a borrower. Those are things that come up possibly within a strategy of notes. This provides you additionally with the hypothecated model and then in the fund to still have your collateralized opportunity and earn the double-digit return and have a vested qualified partner or operator, or in other words, president of the fund, in manufactured housing that has an established presence here in the Valley. I think we've done 300 transactions here in Arizona with our seller finance program. So if we need to reseller finance to someone, it's not an issue, and we can still create the same bank quality note from the very beginning.
So Ray had a couple questions, and I think Jamie had a question also. And just to go back and review, because I think one of these is actually important to discuss, which is the pros and cons of investing in 55 and older versus all age parks. And you touched on it just a little bit, but there's super pluses with investing in a 55 and older park. There's super pluses in investing in an all age park. And I'll just throw you my perspective in regards to a couple of them. Number one, if we talk about 55 plus parks, those people are retired. They're really at their last living environment before they go on to assisted care. So the interesting thing about that is the chances of them defaulting is very, very slim because they're on fixed income, they're retired, and they're going to be there. They could be there another, from 55 to another 20 years, we estimate. The average person will be around another till 75, mid 70s or whatever. And they work really good. There's not a lot of movement with them, meaning that it's just consistent. It's like paint drying on a wall. You're just collecting that check every single month because they're not in a moving situation. They're coming from the Midwest, coming down to Arizona. This is their retirement. They don't plan on moving during their retirement. They're staying at one place. In the comparison to the alternative, the all age parks, those people, if they get a continuous income raises or they keep having more kids in their family, they could move at any given time into all age park because they could be growing up and things are happening in their life and their kids get older or whatever, and they want to move to a bigger space or whatever. There's more movement in all age parks. So going back to it, 55 and older parks, there's better value because there's not as big as demand as all age parks regarding value. All age parks have a higher chances of the value of the home appreciating because the consistent demand for lack of housing in the market. You have a lot of people that are understanding that it is actually not bad to live in 1,200 square foot 3-bedroom, 2-bath remodeled home, and they can live, buy it with financing and including their lot rent and their loan payment. is about what they'd be paying normally in rent. They're paying about the same amount. Hey, it makes sense. We're paying $2,200 to rent a 1-bedroom apartment. I can pay $2,200, and between the lot rent and my loan payment, I'm going to be at $2,000 to $2,200 a month with this company. I'll take it. And I'm actually now a homeowner. It's a manufactured home in a park, but I'm still an owner of a property that could appreciate. I could do what I want to with it, and it's just a winning situation. So to me, those are the pros, my perspective on the pros and cons. That, you know, I'm not sure of exactly so much of cons. It's just a matter of which one you would prefer to invest in, because we have notes in the 55 and older parks. We have notes in the all age parks. The all age park home notes are going to be probably at a higher balance than the 55 and older parks. So
Yeah, so the pros and cons and disadvantages and advantages, I think it's great to have a great diversification across the two. I wouldn't so much choose one over the other, at the end of the day, because they both have validity, within the program. And you guys pepper in these questions in the messages. That's great. So appreciate that, Jamie and Ray. Happy to try and answer, all your questions here today. On the hypothecation model, we can't so much quote a rate of return, but you can lend your money at 10%. So if you feel comfortable with a 10% number on a hypothecated note, that's what we could collateralize that note in the program. What are the advantages and disadvantages of investing in a note and the hypothecation? Well, with hypothecation, it's true passive. It's hypothecation is kind of like the fund. So we'll do the three, right? So the note, you receive a higher yield. You buy the whole note. You're subject to potential of non-performance and having to deal with loss mitigation or making additional profit, paying commissions, stuff like that. With the hypothecation, non-accredited, you're on a single asset. You still earn a double-digit return, but now the person that introduced you to this note program is actually a vested partner, and we happen to have cultivated a dealership of manufactured housing with 5 in sales, 5 in management, 15 in rehab, 25 homes in inventory, a regular niche market specialist in manufactured housing. At that point, if a home were to go non-performing, we would reperform the asset, and you would probably go in a deferred interest-bearing program, and we reperform the home and risk loss to the investor, which is the super win potentially within that program. With the fund, you are fully passive, almost like you're putting money in the bank, and you earn a 10% return for a 1-year term accredited. That's a 506c fund, and it's backed by the portfolio of notes. So opposed to being subject to performance and non-performance of one note within the fund, as we receive capital, we tackle more portfolio, right, of these notes that we originated. It's all our notes, and you're not subject to one specific asset. So hopefully that clarified the hypothecation model, the pros and cons. You got your 55 and older and all age. We hedge across, in order to mitigate. I think it's important to understand the insulated environment of Arizona. The term, I wouldn't call it so much low cost housing. Low cost housing's turned to affordable housing, because the affordability crisis and the state of emergency election nationwide, but also here in Arizona. So, that being said, that's kind of the pros and cons. Arizona's insulated it, and, the potential returns that one could end up participating in, subject to performance and non-performance and things of that nature. I'm going to open it up quickly for a couple questions. We still got 20 minutes here, but who handles disbursements of monthly funds to investors? Great question. So we, at table of origination, we originate the note and require the borrower to get third-party servicing, which puts not only a wall up in between the borrower and the lender, but it sets up automatic funds transfer services, which is actually the company's name, AFTS, Automatic Funds Transfer Services. And the payment comes out You normally on the 1st or the 5th, depending on how we set it up in the beginning. And within a few days after that, whoever has the rights to the receiver of the payment, depending on hypothecated or the whole note, here's the two differences, right? In the who receives first touch of that payment. In a full note acquisition, at that time you would be the one to receive the full payment. So you would receive it from AFTS with your full yield, and they actually send a monthly email update of an amortization schedule and provide service for the borrower too, to call them if they ever need to make payment or have a question and things of that nature. Under hypothecation or in the fund, ultimately on the 15th is when we benchmark payments. So we just 2 days ago sent about $32,000 out to our investors, not including the notes that we sold 100%. So that number could have been $50,000 yesterday. Ultimately, that individuals received in a performing nature. So that was through AFTS. So depending on hypothecated or through the fund, it's around the 15th. We collect payments and deal with the servicing and ultimately take our portion and the investor their money. Within the full note acquisition, you would be receiving emails direct from the servicer because you hold the master lien.
Hey, Alwyn, I just wanted to throw in one more comment real quick about the difference between the all age parks and the 55 and ups. A lot of times what it comes down to is the cost, because the all age homes run somewhere in the 70 to or 60 to $150,000 range, and the 55 and ups are 25, 30,000 up to 60,000. So it could be just a matter of how much capital you're looking to deploy. If it's not in the, 80, 90, $100,000 range, then your choice may be only a 55 and up.
So Ray had a couple other questions on here that we see. It says, who handles disbursement of monthly funds to the investors? So if it goes through the fund, they get dispersed from the fund. So the fund says a direct deposit. If you do have the ability outside of the fund to invest in a actual note on a construction side or a portion of the long-term note, then that would be through our Win Mobile Homes company. We have a full bookkeeping platform that sends direct deposits. If you own 100% of the note, you're actually going to get a 1099 from the actual servicer. Will send you the information, because they're the ones it's really who is dispersing the funds out. And each time, from my perspective, you're going to get a 1099 based off of whatever income that you're receiving, whether it's from the servicer or if we're paying you direct, or Silvercrest or Win Mobile Homes is paying you, you're going to get a 1099 for the income that you've received at the end of the year. So we make sure that those go out properly, subject to having the correct information. So lots of information to kind of unpack. We actually went through a lot. One last thing to note. So again, I like looking at it on the side of a regular note investor and what they get. So when you close a property, if you're buying 100% note with us and it's actually going through title, just know it's a little bit different. So we use 99% of the time we're using a third-party service like Pioneer Title to set up the title transfer and the sale and close of the property. On a manufactured home in a park, as Jamie had mentioned in the text, it is considered a chattel loan. But think of it, because a lot of people don't know what chattel means. Think of it, it's like an auto loan. It's kind of the same. So if you go buy a car and you use Capital One or Chase or Wells Fargo as your lender, they're going to have you record a lien position. You have 30 days normally that when you buy a car, if you buy it private with somebody, they said when you get the title, you need to record our lien on the property. So it's the same thing on the manufactured home. We use, as a licensed dealer, we'll use primarily Pioneer Title, which is the regular title company that even does single family homes. They are going to verify and validate, and they have a a insurance behind them as a regular title company, they're going to make sure that you're getting a free and clear title on that property and that everything's been paid off and dispersed. They also do the recording of the actual lien position. So you're getting that critical thing, which is the lien position. The thing that they don't do in comparison to single family homes is they don't process the actual loan document. So loan documents, just know those are processed outside of title. They still have the same weight as if they were being processed through title because they're a signed agreement, which is the promise to pay. But think of it just like a car loan. If you do a car loan with any major bank or lender, they're going to send you normally a DocuSign to sign with all the disclaimers and all your rights and so forth. You're going to sign it off in a DocuSign or some sort of PDF in regards to it. And it doesn't get recorded with the DMV. So just remember that there's two separate things that are going on between if you're investing in a loan in a single family home, the mortgage documents and the title get recorded with the title company. If you're investing in manufactured homes, it's just the title, which gives you your protection as your lien protection. That house cannot be resold unless the title has been satisfied. The lien position has been satisfied and released. And the document related to the lien is going to be between the borrower and the lender direct. If we're acting as the lender, we use DocuSign, which is a major national platform, to make sure that all of our documents are safe and secure and they're held correctly. So those are two really important things to understand and to follow through. So,
The Silvercrest is the fund. Win Mobile Homes is the dealer of manufactured housing. Okay, Win Mobile Homes is the one that procured the asset, underwrote and qualified the borrower, originated the note via seller finance. An investor bought that note or invested with us, right? If an investor buys the note, Win Mobile Homes, the dealer, not Silvercrest. I see your question there, Jamie. Win Mobile Homes is at your availability at cost, right? So you would pay Win Mobile Homes our fees that are reduced out in the market, right, for retainer attorney and things of that nature. So hopefully that answered your question in the foreclosure. And it's not a foreclosure, it's a repossession, just for fix of terminology, because it is a chattel loan, right? It's not a residential property. A residential foreclosure, a chattel mortgage is a repossession, and that comes with its benefits of shorter time frames and things of that nature. So the difference in an IRA of owning a note in your IRA for long-term income-oriented investment strategy for retirement is only different in the procurement of the funds and then the documentation of the execution and agreement to buy the note. So say Jamie was mentioning she was with Directed IRA. Directed IRA is great. They were over there at Azria with the booth the other day. But from our correspondence, they'll be initiating their documents in order to fulfill a commit to the note or a contract, right, to buy the note. And they'll send it out. They'll sign it on behalf. They'll ask you, obviously, for your approval to execute the contract of which deal it is and things of that nature. So the IRA will actually be the one on lien. So yes, a lot of people use Directed IRA, which is interesting. Raise a client to theirs as well. So it seems like they have a pretty good market share of what's going on out there. But the IRA will hold the lien, and you'll never be involved personally or in an LLC, right? You own the IRA, and the IRA owns the lien and collects the payments. You don't ever touch the fee. Doesn't come to you and you buy the note. No, it comes direct from Directed IRA. They fund the acquisition of the note to Win Mobile Homes, and those payments go to the IRA. So you're completely impartial. You don't own it. Your IRA does. And that's why that comes with its benefits of the tax defer or tax-free exemptions.
This was great questions, by the way. Very valid, pointed questions that are specifically related towards investment. And I appreciate you guys posting those questions because it helps lead us along in regards to our conversation. We never know exactly what the questions are, that's why I always like trying to back up and say, okay, well, what are the basics and what are the alternatives, which is most people look at investing in single family homes and what's that mental thought that that investor has, and how do we change that scope to get them to understand that they can diversify their money that they have available and spread it out over multiple notes that are secured by lien, and it's the same. Actually, I think it's a little bit better quality note than the verification of a single family home buyer, and you're diversifying it out like 5 to 1 on 500,000 bucks, which is really pretty interesting.
Last thing on the IRA information, just so you're understanding expected timelines. So say, and I think there are two people here talking about IRAs are already clients of Directed. So the Directed IRA is actually a custodian, right? So how long does it take to get funds into a new custodian, a new relationship? Well, that's subject to the liquidity of your stocks that you're selling and things of that nature. And that could take, 5 business days, 3 to 5 business days to get your money into your Schwab account or whatever. And then you initiate a new relationship with a custodian, right? So what does that take? That could take 3 to 5 business days. So that's about 2 weeks to go liquid, start this new vehicle in directing your IRA and finding a custodian, opening your account, enrolling, paying your enrollment fees and things of that nature. So that's about 2 weeks. The benefit of already having a custodian is I think it's like 7 days. Once you have your money already in the account, you found a deal. We correspond on a 24-hour basis of someone that's committed to a note. We send it to them within 24 hours. They commit. We send that information to the custodian. We'll probably take note of what your IRA's name is and execute that on that contract. Send that to the Directed the custodian, right? And they'll initiate further documentation that they're required within their file in order to execute that transaction. And that's about a 5 business day process. So just be aware of expected timelines and things like that. It's always best to be educated about, how long that takes and things of that nature. And if you already have a custodian, it makes things a whole lot easier.
Great summary from that.
Super gems today. Like James was saying, pointed topics, wealth preservation. Just want to touch before we cut off here. We got about 7 minutes on the events that we're attending. So here at the end of this month, we're going to the IRA Summit. That's actually hosted by Directed IRA in Austin, Texas on April 27th. I think
April 25th to the 27th.
yeah, so April 25th
7th.
will be in Austin. So if you're watching this recorded mastermind here this week, you didn't get the chance to join, check out that from Directed IRA actually in Austin, as well as May 3rd in Nashville, Tennessee. We'll be at Diversified Mortgage Expo. And I think James is actually on a panel out there as well. At DME, we'll have a booth. We'll be doing interviews and some live content, as well as looking to meet with other high net worth investors focused on wealth preservation and notes. I think there's 1 or 2 more events probably coming up in the near future. At one point, we'll probably throw our own note investment conference or alternative investment here in the local market of Arizona.
So the last event that we've already scheduled for is here in Arizona is Paper Source. And Paper Source is going to be in the Chandler, Phoenix area. I need to get an address, but it's September 18th to the 20th is what it's calling. So there's a local one here in the Arizona market that's coming. Would be good to attend and meet other note investors and learn about note investing.
And if
Great.
you had the chance, check out the podcasts, the vlogs. We do walkthrough videos of the homes. I get client testimonials, investor testimonials. There's education-based content all on YouTube, Facebook, TikTok, Instagram at Mobile Mailbox Money. What is that? Oh, that's Mobile Home Mailbox Money. So search that on Google and feel free to go explore at your leisure. If you're at all curious about, what mobile looks like, in Arizona. It's definitely dramatically different from an Alabama environment. You know, these are quality parks, and it's good to see, touch, feel, and smell virtually, you know, what that looks like. And that's why we put that out there online for you guys to be able to explore at your leisure. I know we had a couple of warm investors actually join here today. So if we could, we'll get back in touch with you today about a follow-up and a best time to contact you. As I know everybody's busy, so we'll make that work at the end of the day. So happy to have you all here today again on the mobile Mailbox Money Mastermind. Same link every 2 weeks. Investors joining, hedge fund managers joining. We had Nate Hare of Directed IRA. We had Nathan Turner of Diversified Mortgage Expo. You know, the list goes on of highly intelligent individuals all in niche market real estate notes. I'm gonna let you guys go. This was invaluable information. Go back and watch if you have at all interest. I'll post this later today on our socials. Passive income.
Great.